Welcome back, everyone. Thank you for joining me. Another wee dividend video. Who are we looking at today? It is Target Healthcare REIT PLC. Another REIT, this one specialising in healthcare, or more specifically, care homes. They operate and manage quite a few through the UK. Ticker symbol is THRL. I want to tell you all how I stumbled upon this stock. I was reading the Motley Fool. A really useful investing website, provides a lot of news, tips and whatnot. There's no affiliate for me saying this. I'm just saying it's pretty good. I've found a few good articles. It's helped me find a few new companies for the videos. So yeah, fantastic all round. But I'll be jumping over to a screen you're much more familiar with. A wee Google search of LSE THRL will find Target Healthcare REIT. Trading currently at 112 pence, £1.12, or about $1.50 for anyone across the water. Last 5 years have been, it's very, I must say, like 5 years ago it was 116 and now it's 112. Now it did have a severe dip in the pandemic, and even into the middle of that first year of 2020, it had yet another dip down to 90p. Had a recovery up till the middle of August 2021 and hasn't been really on a decline. Last year, it is down 7%, but it just seems to be very, very stable in this region, sort of never really dropping below £1, never really going beyond £1.20, 20p difference. Rare you see that in a lot of stocks. Just an observation I thought I would throw out. Dividend yield of 5.98% seems almost too good to be true. There is a little bit of risk that is carried with that, and we'll be discussing it later in the video. So yeah, as I was mentioning, they are a property company with healthcare and holds a large portfolio of care homes. So a bit of a different REIT than I've featured on the channel. They do have a few competitors that I will be featuring, so maybe healthcare REITs won't be so unfamiliar on the channel. Let's bounce on over to their website. There is a wee section here on their business model, research, investment case. Then some investor news, or this is like their relations page. So there's all the literature, all about their earnings and whatnot. Properties, we'll be having a wee look at that later as well. People, you can investigate the board and who's on it, and responsibilities. But we'll be mainly looking at the business side of things. So, their investment case. They claim it is a good opportunity. Now, we're going to read into that and come to our own conclusion on this one. So, significant investment is required to provide modern homes sufficient to meet both organic demand and an increase from demographic changes, and to replenish the closure of older stock, aka older homes. Because later on down here, it explains that the market is actually the elderly healthcare market is fragmented and dominated by small owner-managed providers, many using converted properties or older built homes. So a lot of those homes aren't exactly up to scratch with our continuing, increase in policies. For example, a lot of them don't have like an ensuite wet room in most of them, but as we go on, there we go, 28% of new ones do have them. So obviously that is going to be the case, but the main reason that they claim they're a good investment is in little under 20 years time, there'll be twice as many elderly people over the age of 85. Now, you are only as old as you feel at times, but statistically there will be twice as many people over 85 by 2041. So it clearly is an emerging market that someone needs to take care of. We need elderly care homes. We need more capacity. And that is just a reality that we find ourselves in. Now, obviously, they call it an opportunity. And here in our capitalist society, that is the way it goes. Bit of an opportunity. You can be assured if there's money to be made, someone's there. Now, risk versus reward for a portfolio. They claim that they're actually in the reduced risk. Now, there will be more elderly people. There will be an increase in demand. Otherwise, the likes of retail, office, and industry all sit at a slightly higher risk. But this doesn't come... Now, everything I told you sounds really good. This business is painted really well. However, there does come a little bit of an issue down the line. Now, I'm actually going to bounce on over here to my favourite thing in any business is properties. Where exactly are they? Now, they own about 4 care homes over in my little part of the world in Northern Ireland. There is Ireland is also here. Some people see these maps and think we're just an island on our own. No, there is Ireland that is attached to us as well. And then the predominant, they've some in Northern Ireland, some in Scotland, like one in Wales, just a single one. And then the vast majority are concentrated in the north of England and the Midlands. Actually, not that many even towards London and whatnot. I wonder why that could be the case. 98 properties, 54 million in rent are brought through. Property value 870 million. 96% of them have en suites and wet rooms, and 27 years vault. That's pretty good. Pretty good. 31 tenants. Okay, so now that we've done all this, I want to introduce you to a brand new website which hasn't been featured but will be in future videos. Is Simply Wall Street. Provides a good bit of an overview. Now, you do have to pay for it, but I'm on the free plan here, so I'll be able to do 5 companies before I do have to pay for it, to which I think I will, just for the sake of the channel, so you can all see. I think if I do one a day, the plan is it's £8 a month, and I get access to 30 companies, which I can then do maybe one a day if I find the companies before using this. So we're gonna just go back there. Oh, can I go back? THRL. Come on. There we go. Clickety click. Okay, so let's see. Good things. Earnings are forecast to grow, and earnings have grown over the last 5 years. Dividend of 5.98% is not well covered by earnings or forecast in the next 3 years. That is a problem. That we're about to find out here. We're going to go down to the dividend. It is not great because their financial they don't have enough earnings to cover it. That is essentially the problem here. They are on a 15 price to earnings ratio according to Simply Wall Street here. With they're actually quite high compared to some of their competitors. Their payout ratio, that's it, 266%. Now that is not great, because as you can see, the revenue there, gross profit, earnings, and then they pay out quite a bit in dividends. So these are things to consider. It's not, the stock isn't completely done with, but I don't know. I'm a bit dubious when they can't fully. I like a company that has a low payout ratio, so they have a good bit of excess cash to cover it. Now, there might be a few reasons for that, so we are certainly going to have a look. Let's go over to Dividend Max. Now, Dividend Max here. Oh, this was the one that was delisted. Hold on. Let's go to the one that is now listed. I think I used that one earlier because it says there's only 2 dividends, but the delisted one, actually, they've been paying dividends for about 7 or 8 years. So they were consistently growing, and they are still growing. It's just the concern of whether they can cover that dividend, because you know what happens if they can't cover it? They simply cut the dividend. And you don't really want to buy in, because then if they do cut the dividend. But their stock price is pretty attractive too. There's so much to weigh up when you're looking at a company and what sort of risks you're willing to take for certain dividends. Is it a sector that you're passionate about or you want to be involved with? Then it might be for you. We'll be looking at their other competitors, so I wouldn't take them entirely as the only one to go to, because there was a few competitors, as you've seen in Simply Wall Street, that I will also be covering. Now, for anyone new using Dividend Max here, I just want to cover here that they're a REIT that pay 4 dividends per year, and their ex-date was 13 days ago. Now, what does the dividend date mean? The ex-date means that is the date you must own the share in order to be entitled to the dividend payout, the payout going to your brokerage. If you own a share on the 11th of August 2022 and you sold it the next day, you will still receive the dividend. Declaration date is just the date they announce what they'll pay and when they'll pay. So if you had 100 shares, you would have got £1.69. If we had 1,000 shares, we'd have got a payment of £16.90, and that would have cost you about £1,100. It's not too bad. Not too bad at all. Right, over to my brokerage Dividend, Trading 212. So having a wee look at them here gives you a quick brief overview as we've already looked at. You can see CEO, headquarters, industry, whatnot, revenue. Now, I want to show you the charts here. Income statement. See, revenue to income, it looks good. Very high profit margin. Total assets and total liabilities, again, very, very good. Their NAV's not too bad. NAV being net asset value. Now, here's the kicker. They have been investing. Now, what does investing mean? It means they've been investing in new facilities, new care homes and whatnot. Now, problem is, total cash paid out in dividends, 31 million. Operating is 296 million. Net income is 43 million. So, once you subtract a lot of these, net cash change of minus 15 million for 2021. Now, the 2022 financials won't be out to the end of the year. I wonder if... Let me see. Yeah, I was just having a wee quick look there. So their cash went actually down 42 million this year from 49 last year. So current net assets to liabilities is minus 13.4. Not fantastic, but again, it is a potential for any portfolio given the right investor. So yeah, well, let me know in the comment section below. Is this a company you would look into? Is there a competitor that you know of that you have already invested in? What do you think of the industry? And let me know, and we can have a wee chat in the comment section below, lads. Thank you for joining me. I'll see you in the next one. Bye-bye.